Let's hit Hasbro right now because shares have been all over the map today. They initially fell sharply, as you can see. Actually, they initially rose, and then they fell sharply after the company issued guidance and have come back since into the green, up 2%. The news was they cut guidance for 2022, but also announced a big restructuring plan where they'll cut hundreds of millions of dollars in costs over the next 3 years and have outlined a new strategy for driving sales and profits. Shares are down more than 30% on the year. Joining us now is Hasbro CEO Chris Cocks. Chris, thank you for joining us, fresh off of that Investor Day. Welcome.
Oh, thanks for having me, Sarah.
So first on the guidance cut, what is it out there that you're seeing right now that is weaker than expected?
Well, we knew going into 2022, Q3 was going to be our toughest comp of the year, and indeed it manifested that way. You know, as we look for the balance of the year into Q4, we see a growth quarter, but we have some concerns around particularly some entertainment deliveries, which cause us to have a more measured guidance for the full year. Now, that said, you know, we think Q4 cues up our new plan, which we're calling Blueprint 2.0. It includes a blockbuster lineup of entertainment, which starts off with Black Panther: Wakanda Forever in November, follows that up with 7 consecutive blockbuster movies, 2 of which will be our own, including the upcoming D&D Honor Among Thieves film in March, and then following that up in July with Transformers: Rise of the Beasts, the 7th blockbuster film in the Transformers franchise. And then we have a ton of new innovation coming out, like our new Nerf Gel Fire Blaster, as well as Wordle the party game based on, you know, the internet sensation Wordle. And then we have announced an all-new cost savings initiative and operational efficiency initiative that we see having rising impact quarter over quarter.
So do you think the street, you've talked a lot about entertainment and you're talking about sort of refocusing the priority businesses and the key brands. Do you think the street understands the strategy or thinks of you as sort of an old school toy maker? What's the disconnect?
Well, I certainly think the street appreciates the power of the brand Blueprint. It's been a great strategy for us over the last decade, driven a tremendous amount of return. You know, over the last couple years, as an industry, we've had to deal with COVID, we've had to deal with supply chain challenges, and most recently, inflation. I think the strategy we outlined today focused on fewer, bigger, more profitable brands, leaning into our gaming strength, which is a $2 billion super high profit, high growth category for us, and the $250 to $300 million of operational run rate cost savings that we can achieve over the next 3 years. I think our investors and analysts were impressed.
Where are the cost savings going to come from? Is that layoffs?
It'll be a combination of what we call labor and non-labor. Labor includes contingent staff and includes full-time staff. Non-labor includes systems, inventory, and a variety of other aspects of our corporate overhead. You know, the first half will be a little bit more focused on labor. The second half will be more focused on non-labor, particularly as we make those system investments to drive our supply chain, drive our improved demand planning, and gain efficiencies in IT.